Hello investors, in this video we're going to take a look at Verizon, and why we are looking at Verizon is because of, first of all, of the following chart. If you look at the following chart, which is going from 84 to present, 2022, we are looking at a long-term trend line, and we are currently at and near the long-term trend line, around $36.50. We bounced almost from this trend line in the crash of 2000.com crash in 2001. If you look, I plotted here an RSI, so RSI reached level of around 25. So then we got close to it somewhere. Well, we got to it in the crash of real estate crash of 2008, and we are at the same level right now in 2022. That is not to say that it may not break below this trend line. However, at these levels, the company is starting to look very, very, very interesting, especially since at this level we are getting almost 7% in dividends. Well, I'm becoming greedy. I want the money. I really want my 7% of dividends. So hopefully you're a saver too. So if you are, then what I'm going to be interested in is the strength of the balance sheet, cash flow, and the safety of the dividend payments. And then I'm going to do evaluation. Again, technically, the company looks ready to bounce, and if I was a technical trader, I would probably start buying somewhere around here and just would wait for it to bounce, because we have a good history of Verizon bouncing from being oversold from these levels. So let's go ahead and do our review of the financial statements and do the evaluation for Verizon and make a decision.
So let's look at Verizon's financial statements for the past quarter ended September 30th, 2022, or 9 months periods. So revenue, if we compare just 3 months ended September 30th, 22 and September 30th, 21, revenue grew only at a rate of 4%, somewhat below inflation levels. We have official inflation levels at around for the same periods at around 7 to 8%. So it is not too bad, but not too good. For if you compare 9 months periods, revenue grew only at a 2% level, which is quite disappointing. Simultaneously, in these periods, total expenses grew at a rate of 9.7% if you compare quarters, or 5% if you compare longer periods, 9 months periods. So for the 9 months periods, revenue growth 2%, expense growth 5%. So our expense growth far outpaces our revenue growth. Not good. Not good. I'm sure Verizon knows it, and they will do something about it in the near term. However, let's look further. Then, obviously, since our revenue growth is slower than our expenses are growing, this affects our bottom line. So, obviously, we are showing lower income, decreased income. So, income actually decreased almost 16% for the 9 months periods, which is not good. Or, if you want to see a really ugly number, it's at 23%. Compared to if you compare the quarters. So not good at all. So however, I'm going to use this number, the earnings generated for the past quarter, for the quarter ended September 30th, 2022, as the earnings per share, as the base case for our earnings per share. I don't feel that earnings are going to go much lower. They're probably going to stay at this level. If they do go lower, I don't suppose they will go lower for a long time. So again, my valuation is going to be based on the assumption that $1.17 per share of quarterly earnings is going to be stable going forward. Let's go ahead. Okay, so looking at the balance sheet, what do we see? Assets grew by almost $8.5 billion, not bad. Current liabilities grew by $6 billion. Long-term debt has decreased by $3 billion. So nothing extraordinary here, nothing, a typical balance sheet of a big stable business. Nothing really I don't see what is here to pay attention to. Equity. It's a slow growing business that is repaying its equity via dividends to the shareholders. So the equity is growing. It grew by $5.5 billion, but it is growing slowly. Obviously, we're not in a fast-paced business. Let's look at the cash flow. Statement of cash flow. Obviously, we have some problems. So operating cash flow went down compared to the 9 months period of last year, which is not good. But still, in our models, it doesn't look disastrous. It looks acceptable. Then we'll try to estimate free cash flow. I'm not going to use these numbers because these numbers were some extraordinary activities that Verizon is not going to engage to on the regular basis. So we will assume that these investment activities, I'm going to take all of the numbers just to be conservative, are going to continue on a regular basis. So $28 billion minus 23, we are going to end up with a free cash flow of $4.8 billion. Then in the cash flow from the financing activities, we have these items. These items are just regular movements of cash to finance the company, closing of loans, opening up of new loans. So I don't think there is much you can find here. Especially if you look at the balance sheet, on the balance sheet, everything looks normal. What is important to us is the $8 billion number in dividends paid. So free cash flow almost covers up the dividends paid, but we have a $3 billion shortfall. Here we need to return to the balance sheet and long-term liabilities. Again, it's a slow growing business that is repaying its earnings via dividends to the shareholders. During the past 9 months, they managed to repay $3 billion in long-term debt, and they have no problems. If ever any problems arise in terms of dividend payments, I would assume Verizon is going to borrow more money in the long-term debt section to pay the dividends, or they are going to have to tinker around with their cash flow from investment activities. So I don't really see any problems with dividends. To sum it up, Verizon needs to work on its growth. They need to work on their pricing models, and they need to take care of their costs. But simultaneously, the business looks very stable, and there are no disasters. It's not overdebted, and I don't see any problems with the current dividend payments. They can be maintained for years to come. So let's do evaluation of Verizon. I'll assume 3 scenarios, normal, based on the worst cases. So in the normal case, my assumptions are going to be that the growth rate is going to be 3% over the next 10 years. I assume it actually is going to be faster due to inflation, but let us assume even in our normal case, let us be somewhat conservative. Then I'll assume a discount rate of 12%. Again, that's a fairly conservative discount rate, and a terminal multiple of 8. Right now, Verizon is trading at a P ratio of around 7, between 7 and 8, so that's, well, fairly conservative. So, and again, technically Verizon right now is severely undervalued, so that is too normal to very conservative assumption. I'm also assuming a $1.17 a share per quarter income. Again, as discussed previously in the financial statements, this income looks fairly safe. So I'm assuming that that's going to be the baseline from which the company is going to grow. It may fluctuate here over the next couple of years, but again, I'm assuming a fairly conservative growth over the next 10 years. So even if earnings fluctuate somewhat over here, our growth rate assumptions are very, very conservative. So with this data, in our normal case, the present value of Verizon should be $46. Right now we're trading at $36.50. So roughly $10 undervalued, or like over 20%. Our best case scenario, 5% growth over the next 10 years, same earnings. Well, I'm assuming a terminal multiple of 12. Again, if you return to the technical chart of Verizon, right now we are at the bottom of our long-term trend line, and RSI is in historically oversold area where Verizon was only in the 2001 dot-com bubble crash and 2008 bubble, real estate bubble crash. These were really abnormal situations. So in the best case scenario, again, I'm assuming that this is the area of our normal case. In our best case scenario, I'm just assuming still a fairly conservative terminal multiple of 12. So that is if things get a little better. So with this data at the discount rate of 12, again, which is very conservative, the fair market value of Verizon should be around $61, which that's approximately where the company was just about 6 months ago. So let's move to our worst case scenario. I'm assuming a 2% growth over the next 10 years, which is extremely slow. It has to grow faster than this. It's a technological company with a lot of infrastructure equipment, infrastructure investments, so it's gotta grow faster than this. But, well, that's real life and things may happen. So, again, worst case scenario, 2% growth over the next 10 years. 12% discount rate and terminal multiple of 5. So I'm assuming a complete disaster. I'm assuming that in 10 years we'll enter something, we will have barely any growth, and I'm also assuming that we will enter probably the US is going to enter the world of extremely high interest rates or completely disastrous time. So this scenario is really a disaster. In this case, the value of the company should be $38 a share. That's still above the value of what Verizon is trading at right now. So 36 and a half. So Verizon is, even in our worst case scenario, Verizon is still undervalued. So I'm going to assign values to this scenario. So to the normal case, I'm going to assign the probability of 60%. Again, our normal case is still very conservative. 3% growth is income growth is a very conservative number. I'm assigning a terminal multiple of 8, which is again a very conservative number, which corresponds to disastrous times such as dot-com bubble or 2008 real estate crisis in the US. So again, even our normal case is very conservative. So I'm assigning to this case a probability of 60%. To the best case scenario, I'm assigning 20% probability. Again, we were at this level just 6 months ago, so even my best case scenario is still a very, very, very conservative case. And then to the worst case scenario, I'm assigning also a 20% probability because I don't really believe that this is probable. However, I still need to take into account all the possibilities. So in total, our value, assuming all these scenarios, our value is going to be $47.50, while we're trading right now at $36.50. So clearly, Verizon is undervalued by about 20-25%. And there are good dividends. The dividends are safe. And I would assume that it's quite a safe, conservative bet. I would even assume that you could probably use a little bit of leverage to buy these stocks if you can obtain leverage fairly cheaply. That's it. If you liked my analysis, subscribe, comment. Cheers. Goodbye.